All right. Before we get going, we have to do our wonderful Appease the Lawyers segment. So, access to this webinar is for educational and informational purposes only. Consult a licensed broker or investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither T3 Live, LLC, nor its affiliates or any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website at www.optionsclearing.com to read characteristics and risks of standardized options. T3 Live provides educational training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We're not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose, and make all trades in the T3 Live program in a paper trading account. Past performance does not equate to future results, and results discussed in this webinar are not necessarily typical. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss or losses you may incur from the information discussed in the media identified above. All right, got that out of the way. Thank you very much. Hey, well, welcome everybody. There we go. So, what are we talking about this week, and what are we doing here? This is the fundamentals of options class. Now, let me go over a couple things that we're going to basically be trying to hit and kind of my goal for you over the next 3 days. We're going to be going over basically, let me see here, the core ideas of what makes the options market work. Now, I'm going to start with the basics, and I'm sure, I understand that many of you probably already know what the heck an option is. But I find that a lot of traders don't actually understand the real core of what makes an options price tick, why it changes, how it changes, and I end up seeing people basically making really bad decisions based on that. We're also going to dive into what does it take to get executions filled, what does it take to actually use options, and some of the basic concepts of actually making options work for you. Now, there's a lot of things that are different in the options market from the broad market, and understanding how those things, from the stock market, forex markets, futures, bonds, all of those, options are a different animal, very, very different animal. Understanding how those work and how they are actually inefficient and don't work actually in a lot of cases give you the ability to really build trades that make sense and actually give you an edge. Not knowing that stuff ends up basically meaning that you make poor choices sometimes. You might not even realize you're making a poor choice, and you end up exposing yourself to a lot of risk that was unnecessary, and you don't get a chance to make some of the profits you want to make. Now, to do this, we're going to cover a bunch of different topics. Today is really basic, fundamental stuff. What's an option? What makes them work? How does the options market actually function so that we can get an edge? How do we build out an edge in our trade? How do we create basic option combinations and use them? So that's going to be the basic concept today. We're not going too deep into any overly complex trades, but I want to give you a sense of how things kind of fit together and how options can be good for you. Now, tomorrow, we dive into the Greeks. Tomorrow, we're going to get into what I consider one of the most core and fundamental tools you have in options. You can trade options without knowing what the Greeks are. It is possible. But it's like trying to trade something by looking at its shadow on the wall. You're not getting the full picture. Options allow you to create a huge variety of different trades, and not even just a different trade, but versions of the same exact trade that achieve almost completely different goals. And unless you know how to work in that, you can't take advantage of it. How do I make something that makes me more money and reduces my risk? How do I build a trade that, allows me to turn this idea that I have about the stock movement into a profit? Or better yet, how do I create a trade that doesn't even require a stock movement, and it, basically works on something totally different to make money? There's a ton of ways of making money in the options market. And honestly, about 80% of them are not focused on whether or not the stock that the option is on is moving. To be able to take advantage of those trades, you have to understand basically how the options prices are going to change. And the Greeks will tell us that. And then Thursday is going to be working on how do you build a system for yourself for managing trades and basically using options trades to make you money. Kind of pulling, giving you the overall framework for managing your trades and creating a portfolio of trades that actually work well for you. So that's the big goal this week. Today, we're going to be understanding options fundamentals, getting an edge and getting the fills, and some basic options and their use. Now, I'm going to start off with some slides. And by the way, for anybody who asks, and by the way, this is always the same question I get all the time. We are recording every one of these sessions. As they're rendered and basically stored, we'll send out links for you to basically review the session, and you'll have that link permanently so that you can watch the session anytime you want. All of the slides that I do, I will convert over to a PDF, and we will also include those as a PDF attachment that you can get your own copy of. So everything you see on the screen, don't worry about trying to do screen captures or anything like that. I'm going to give it to you. A good chunk of what we are going to do in these classes is actually going to be on an options trading platform. I'm going to use thinkorswim, and that's my primary trading platform. But nothing I do is unique to thinkorswim. The same concepts and the same tools apply whether you're in Options House, thinkorswim, Lightspeed, Options Express, TradeStation. All of them are the same concepts. So I'm not trying to do anything that is limiting and says you have to use a certain brokerage. You don't. You'll be able to do pretty much anything you want on just about any brokerage once you understand what you're looking at. Now, let's see here. Getting the most out of these labs. All right, this comes down to the way I like to work. Actually, quick little test. I should have done this before. Can everybody hear me fine? Is everything nice and clear? Can you hear everything? Can you see everything without any trouble? Tina, you're good. Very good. I hope so, Rob. You wouldn't believe the amount of money that I've spent on microphones and stuff for this office. My office has this kind of Larry King Live look to it. I've got this big old hanging Yeti blue microphone with acoustic foam up on the walls. It's kind of funny, actually. But good. So we're in good shape on that. So when I do these sessions, I don't know, maybe I'm the same as other people, maybe I'm different, I don't know, but I actually enjoy working with the people in the group. And by that I mean I like to get good questions, I like to have interaction. My goal is not to pound through a bunch of slides by the end of the day. My goal is to make sure that everybody understands what we're talking about and clearly gets the concepts so that you can use them later on. During these sessions, we're not going to be pumping out a bunch of trades. That's not my goal here. We may do some trades and set some things up. And if that's the case, then absolutely, you're welcome to make your own decisions and use those. But the goal is for me to make sure that you understand what you're doing in the options market. So as you get more and more experience and build up your skills, you can be a better and better options trader. I want to give you the foundation to do that. So interaction is good. Ask me questions. Don't hesitate. You don't have to ask permission to ask a question. Just toss a question out and I'll answer it. If it's complicated, And this is a small group, so this works out fairly well. If it's a complicated question, just say, can we do an audio, may I get on the mic or something like that? And I'll turn your microphone on. If you're comfortable with that, we'll just have a quick conversation. We try to avoid that too much because then it gets a little too jumbled if we have too many people in here. But always happy to dive into things further. And bluntly, you make my day a lot easier if you do ask questions. So, please do. Nothing worse for me than sitting here watching a group of people twiddling their thumbs while I'm talking. So, I already mentioned the recordings, I already mentioned the PDF files, and periodically I will hand out spreadsheets, just little tools, useful things that I've built up over the years. Happy to share them with you. You will need Excel for Windows 2010 or above. Now, the reason for that is that most of the spreadsheets that I use or have built use information and data from the internet, and for them to run, it needs Excel 2010 or above. Let me see, we're in 2017 now. You've had time to upgrade. If you're going to use Excel, it's definitely worth getting a copy. If you are going to buy a copy, I would recommend the most recent version, 2016. That'd be the best version. All right, so anybody have any questions before we get rolling here? Thoughts, questions? Where are we going? Who the heck are you and why are you talking to me? Anything? All right, I got a question before we roll. Where are you all from? I always like to get a little sense of that. DC, Colorado, KB, Bay Area. Which Bay Area? Tampa Bay Area, Hudson Bay Area, San Francisco. Excellent. Yeah, actually, I think we were mentioning something about that. I was actually looking to move out to Half Moon Bay at one point. Ended up moving to the Bahamas instead, but I guess I would have gotten water either way. I just would have gotten kind of cold and foggy as opposed to warm and sunny. Rob, yes. As a matter of fact, today is going to be a good session for you because we're going to talk about why long calls and puts are not the better way of doing things, and we're going to actually explore that a little bit. So hopefully you're going to get something out of this right off the bat. And you're in Chicago. Yeah, I lived and worked in Chicago. I worked on LaSalle Street for a while. Used to live up in Irving Park. I actually moved from the Bahamas to Chicago in November. That probably says something about my judgment right there. Never, ever, ever do that. That's a bad idea. Okay. How's your winter going up there? Yeah, you realize that I lived for years on a little tiny island about 700 feet across, which was a spit of sand about 23 feet above sea level total. I don't think I wore shoes most of the time. I could walk out my front door, walk across the street, across a white sand beach and into the water, swim out 200 yards, spear my dinner, swim back, go up to my house, cook it, walk down the street, hit the pub, grab a couple of clicks. It was a good life. And then somehow I got dragged out and recruited to manage European trading operations for a private trading firm in Chicago. And I somehow thought that was a good idea. Chicago in November is freaking cold. Do me a favor, everybody, and definitely use the all send to everybody. That way, when I answer your questions, I don't look insane. All right, let's get into some actual discussions here. Anything else, anybody? Any final comments? Then let's get into understanding options fundamentals. We're going to start off. Oh, you work for the University of Chicago as manager of information systems. Excellent. Actually, my start was in IT, and I actually had a software development company and a networking company and built that up, sold it off, and then that led to an opportunity to do trading. I actually ran a high-frequency trading firm for about 8 years. And then I was the CIO for a period of time for a credit card processing company. All right, what is an option? All right, you probably know the basics of this, and most of you have heard the term calls and puts, but let's dig into this a little bit. And we're going to start at the basics and work our way up. But we don't want to just know what an option is. We also want to know why it exists, how the price forms, how the price gets messed up, which is a wonderful thing, and how we can use these things to our advantage. So options are actually a very different animal from a stock. A stock represents something. It's almost like a piece of paper that's handed around. The same share of stock gets handed from one person to the next. And the stock basically represents a share of ownership of a company. A portion of that company is yours. Now, an option is a totally different animal. Options are actually legal contracts. And every time you buy or sell an option, that's actually what you're doing. You're buying and selling a legal contract with somebody else. Now, this is an interesting one because you don't know who that somebody else is. You don't know who is on the other side of that options contract. It might be a hedge fund. It might be an options trader. It might be a floor broker. It might be, basically a options trading firm, or it might be a retail trader. You have no idea. But somebody is on the other side of this, and every time you execute a contract, either buy or sell an options contract, you are basically creating a brand new contract between you and another person. Whenever you do a trade that says buy to open, and actually there's sell to open too, you are literally creating a new trade in the market. Now, the types of trades or the types of legal contracts you have are basically revolving around a basic idea. It's the right, when you're the buyer, it is the right to buy or sell a block of stock at a very specific price. So let's break this down. If I am buying a call option, and a call option gives me the right to buy a block of stock at a specific price. XYZ is trading at, $45, and I buy a call option on XYZ for a $50 strike. All right. So why would I buy the right to buy a stock at a specific price? Well, a couple of reasons. One, doing so is often a lot cheaper than actually buying the stock itself. Okay, that's good. So I could basically get exposure to the price change of the stock by buying the option. That's one way of dealing with it. Two, I believe that the stock is going to go up a lot and go well past that strike price, that $50 strike, while I'm holding on to this contract. And that is going to give me the chance to buy the stock at $50, but then sell it at the market price for a much higher price. Okay, that's another possibility too. Now, those are kind of basic, obvious ways of using the options, very simple ways. Honestly, they're not the best ways. In fact, they can be very dangerous when you do that. We want to start to dig into the price because that's a piece of the whole thing. Now, one thing I need to mention is that these options only exist for a period of time. That's a very fundamental aspect of the option. They only exist for a specific period. So this option that I just bought, this call option, allows me to buy XYZ at $50. It's going to expire in a certain number of days. So I have until now and that moment in time, that expiration date, to use that option. After that, it's not worth anything anymore. I can't do a thing with it. And we'll talk about that in a few minutes. The call option is the right to buy a stock at a certain price over a certain period of time. Put options are just the opposite. They're the right to sell somebody a block of stock at a certain price over a certain period of time. they're really the same concept. They're just in two different directions. Um, I basically have stock, and I'm worried that the price of the stock is going to go down. Therefore, I buy a put option at a strike, in this case, maybe $45 or $43, whatever. If the stock goes down, I always have the ability to sell that stock at the strike price of my put option. Before it expires, I use that to liquidate my stock, my long stock, and I basically save myself a bunch of money by closing out my stock trade at a much better price through the option than I would have through the regular stock market. Same idea, just in the opposite direction. So there's the basics. Really, really simple basics of what is a call and what is a put. Every time we get into one of those, we're basically looking at two possible sides to the trade. You can be the seller of either the call or the put, or the buyer of either the call or the put. Now, calls and puts also have a couple of little permutations, little versions of them. There's American options and there's European options, both of which have absolutely nothing to do with America or Europe. Nothing at all. But they're basically describing the way that the option works. And this can be relatively important for you. An American option gives the owner the right to execute that option, to basically, if they've got a call, to buy the stock at the price, the strike price of the option, or if they've got a put, the right to sell their stock at the strike price of the option, any time between now and the expiration of the options. All right, so that gives a lot of control to the person who buys the option. European options actually are different. Oh, and by the way, American options actually deliver the stock. So if I execute a call option, I have to pay whatever the strike price is per share of the stock that I'm getting, and I physically receive the stock myself. Now, this might actually be your goal in one case, or it may not. You may have not want to ever own that stock. In most cases, when we're trading options, we don't actually want to own the stock. We want to just get the financial advantage out of the options. We don't want the stock itself. But the option will deliver the stock if it's an American option. European options are a little different. European options do not give the buyer, the right to execute whenever they feel like. There's only one moment in time when the European option is able to be executed, and that is at the expiration of the option. And even then, you don't get the actual stock. What happens is you get cash. You get the difference between the strike price and the market price of the stock. So you're not actually receiving the stock. But in a lot of cases, you don't want the stock. You just want to make money. At least that's what I like. I like to make money. I really couldn't care less about owning stock. Now, what you're going to find is the majority of options in the market are American options. Almost all of the stock market, just regular stock options, are American options. A good portion of the ETFs are also American options. Then you get over into indexes and some of the specific, mostly indexes, to be honest. And those switch over, and there's a handful that are European options. Some symbols you'll probably hear commonly referred to: SPX, which is the S&P 500 index. Well, the SPX options are actually European-style options. On the other hand, the SPY options, which is the SPY ETF, that's the exchange-traded fund, same thing, by the way. SPX and SPY is roughly the same thing. It's just a different multiple, smaller price. The SPY options are American options. So you have very, very different things going on there. Most of the time, you're probably going to be dealing with American options. Now, we'll talk about pricing in a minute, but keep in mind that American options gives the buyer of the option more rights. European options give the buyer of the option fewer rights. So just keep that in the back of your head for a couple of minutes from now. Now, before we dive into this part, is there anybody who has any questions about just the super basic stuff that we just covered? Does everybody here understand what the put options are and what a call option, what a put option and call option is? Understand also what an American and European style of option is. How many of you, now Rob, you mentioned that you've been buying puts and calls for a long time. How many of you have been active, have traded options? Kind of curious as to where we're starting here. So if everybody just tells me how long have you been trading options, kind of what experience level do you see yourself at? Five years. Wow. Okay. And Tina, don't trade options? Okay. Beginner 1 month. All right. LJ. Hey, what kind of options trading do you do, LJ? Yeah. Don't feel bad about that. That happens to all of us. It's the worst possible thing that can ever happen to a trader is to be really, really successful right off the bat. It kills you. Oh, it like somehow knocking home a couple of really great trades and making a bunch of money right off the bat just makes your brain seize up and you become cocky and you don't learn. I've had some painful moments in the market, and I think those are some of the best times to learn. But I've been there with you. I lived the life for a while. Started out nailing long options. Yep. That's a dangerous one too, because that'll make you think you're doing really good, but actually you've got a lot of bias against you in that. We'll talk about that in a second. Any other? And by the way, Tina, Andrea, is it Andrea? Andrea? Okay. Don't worry about, coming into this fresh. This is what we're doing. We're starting from the beginning. So ask questions. As I said, be involved in the conversation, and we'll definitely get you there. Yeah, LJ, that'll kill you. Absolutely. So what I'm going to talk about next is probably one of the biggest pieces of options trading that most people don't get. All right. And actually, Rob and LJ, and by the way, I'm not trying to pick on anybody on this, but you guys might be able to bring some experience to this. When you're trading, and Rob, you mentioned that you're buying the long calls and long puts, you're looking at options as if they were basically a cheap replacement for stocks, right? And you too, yeah. And it's an easy trap to get into because options are really cheap. You can make some quick dollars, potentially potentially knock home some big trades. If you get lucky, you can walk away with some good profits. And it is possible to make money that way. The problem is that what ends up happening is you don't realize that the odds are really, really seriously stacked against you. And that you have to be very, very right to make that work over the long run. And if you were that right, and by right, I mean just really amazingly good at predicting exactly where stocks are moving to. And if you were that right, there's actually better ways to make money. There's actually much better ways of making money. Much more controlled ways, less expensive ways, much better approaches to doing it. Most of the time you're making money for the market makers. Exactly. That's actually it. And we'll talk about that in just a second. After we get through what makes up the price, we're going to talk about the reality of the market and how the market actually works. By the way, the options market is one of the least efficient markets out there. And that might sound like a bad thing, but it's actually wonderful. You don't want to be in a highly efficient market. A highly efficient market means that everybody has a really good understanding of exactly what might happen to the prices, and they trade all of the extra profitability rate out of the market. Options market, on the other hand, is not a very efficient market. And that leaves a lot of room for us to actually go in and use the options market to our advantage and make more money. A really great opportunity to do that. So we don't want it to be efficient. But whenever you're in a market that's not efficient, you have to know where the inefficiency is, because you want to be on the right side of that. And you want to understand how it all fits together. And you want to understand when you're going to get the greatest amount of advantage versus being on the wrong side. You know, it's a choice really of walking into the casino and owning the casino, or sitting down at the slot machines and being the person who pumps the money into the casino. And that's really what you end up doing. So let's dig into the options pricing first. Some basic concepts of how do options prices work? How do they exist? And once we get the basic ideas behind that, we're going to go into what drives those prices around and what makes an edge for you versus an edge for somebody else. Now we're going to start to get into some of the more interesting stuff. So I have to give you this little warning. When you get into options, you start diving into math. You don't absolutely have to, be a math genius to do options, but it's nice to have a calculator at your desk and be able to make some, basic fundamental calculations. The price of an option is actually made up of a bunch of parts. It's like you're adding up all of these different things until finally you come up with what is the price of the option. So the first price of the option is what we call intrinsic value. Now, there's two pieces to intrinsic value. There's time value, which is actually a little different from the time value we're going to talk about later. And there's what we would generally refer to as intrinsic value. So let's do a little thought experiment. If I have, actually, I'll tell you what. If I have a contract for Netflix and it is a call option, I bought this a while ago. Let's forget what the price was. And I bought a 130 strike call option. Now remember, this 130 strike call option gives me the ability to buy Netflix at $130. The price that I would pay for 100 shares for each of the contracts that I have is $130 per share for the 100 shares. So I have a pretty powerful thing here. I can basically, for each contract, each call option that I have with a 130 strike, I can buy 100 shares of Netflix for $130. But right now, Netflix is trading for $132.89. So if you have that in your hand and you had the ability to do that, what would you do right now? Remember, it's your choice. You can execute this option anytime you feel like it. Spend $130 for every share of Netflix that you're buying. Each contract represents the right to buy up to 100 or to buy 100 shares. And you just bought Netflix for $130. So what you would do is you would execute that option. Heck, I can buy Netflix for $130, and right now Netflix is trading at $132.89. So I can immediately take the stock that I just received for $130, and I can turn around and I can sell it for $132.89. I just made $2.89 for every contract or every stock share of Netflix that I bought. So let's just do a little quick math on that. So I have, let's say, 10 contracts. Every options contract represents 100 shares. There are a lot more options contracts out there that are different these days. There are some minis, and then there's others called maxis. Minis are representing typically 10 shares. Maxis can represent 1,000 shares. Now, periodically, because of stock splits and things like that, you might get some weird ones. Things with really weird strikes, and it's representing 33 shares or something along those lines. Let's not worry about those right now. Let's just assume that for each contract that I have, this call option, I have the ability to buy 100 shares. I've got 10 call options. That means that 10 times 100, I have 1,000 shares. I have the right to buy each one of those 1,000 shares for $130. So I just spent $130,000. Ouch. Okay. But at the same moment I do this, I can literally flip around and sell those shares for $132,890. So let's see, minus 132, is it 890? Oh, come on. All right, well, anyhow, we just made $2,892 or $90. We instantly did that. We flipped it. We turned a call option into stock, turned that stock immediately in the market into a profit. Well, if I was the person selling those options, and by the way, for those of you who are relatively new to these, did you follow along with that? I could buy the stock at, or I could buy the stock at $130, immediately sell it for $132.89 because that's what the market price is. Does everybody get that? It all makes sense. Come on, a little response here. All right. We made $2.89 per option that we had because of that setup. Now, if I was a person selling that option, and remember, I'm selling you the right to buy that stock from me. I have to deliver that stock. It means I have to go out into the market and buy that stock and then give it to you. And you're going to pay me $130 for every share, and I have to buy it for whatever I can get it at. Would I sell that option contract to you, give you that right for anything less than $2.89? Well, Tina, okay, remember, the options contract gives you a right to buy stock from somebody, the person who sold the options contract to you, gives you the right to do that anytime you please. I can buy it at the price, the strike price on the option. Now, what might have been confusing about that, Tina, was that I didn't talk about the cost at all. I just assumed that we had this options contract magically and we were about to execute it. Now, here's the part that comes into play. If I could do that, and I just had an options contract, and poof, I can go and get my stock for $130 and immediately sell it for $2.89. Yeah, I would instantaneously make money because I'm buying the stock at one price, selling it at the market price. The market price is $2.89 higher. I'm richer. But the reality of it is I had to buy the option, and this is where the pricing comes in. So if the person is looking at the market right now, the person who's selling the option, and they're considering, well, what price am I going to sell this option for? There is no way in heck I'm going to sell that option to you for less than $2.89. It would just be dumb of me because you would just instantly turn around and you've got a cost to buy the option, which is less than $2.89. You execute the option immediately. I sold it to you. I have to fill that stock at $1.30 or $130, which means that I have to go out and buy it for $132.89, which cost me $2.89 basically between the two to do, if I didn't make at least $2.89, I'm losing money instantly. That would be what's called an arbitrage. It's when the price of the option is discounted to a point where you can literally instantaneously make a risk-free profit. And you can probably see that nobody is stupid enough to do that, or at least very rarely is that ever going to show up. Nobody is just going to sell you an option because you have to pay for it. No one's going to sell you an option for less than the difference between the strike price and how far in the money the stock is, or the option is, I should say. Now, we're getting into another concept here. It's called in the money. The option strike was $130. If the stock, and this is a call, if the stock is above 130, then we basically say that the option is in the money. The option's price is lower, or the call price is lower than the current price of the stock. So we could now execute the option, receive the stock, turn around, sell it, and theoretically make money in the market rate then. So the seller is not a stupid person, and they need to make some money. First thing they're going to do is put in what's called the intrinsic value. And this is pretty simple. It's just the difference between the strike price and how far in the money the option is. So if it's a call option and the strike price is below the current price of the market, the difference between the market price and the strike price is how far in the money the option is, and it will immediately have at least that amount of cost on the options. So let's look at this. Here we are. I'm talking about a 130 strike. Yeah, right here, these are way more than $2.89. We've got 10 days before these expire, so they exist for 10 more days. And if I go to a 130 strike call, I'm going to be paying $8.50, 45 cents to buy this long call option. Part of that is the intrinsic value of the option. $2.89, 130 to 132.89. All right, so there's one piece of the puzzle. And as I said, options prices are built on layers. There's piece after piece after piece that determines the options price. The second piece is, hold on, time value. Now, we can talk about a totally different time value later on. But for right now, let's assume that nobody does anything in the world for free. Fairly basic assumption. Nobody's going to do anything without expecting at least a basic payment. Tina, did you get that? Follow along with that idea about the intrinsic value? That's not the total price. Okay, good. Now, whenever an option seller sells an option, they're locking up a certain portion of their capital to do it. Now, being a logical, intelligent investor, they know that they could put that exact same money to use someplace else. So we add on another little sliver onto the price of these options, which is basically the risk-free interest rate. Now, these days, this is barely a piece of anything. We're going to talk about this a bit tomorrow when we get into the Greeks. We'll talk about Rho. But let's assume that not only will the option seller not sell you the option for anything less than the intrinsic value, but the option seller is also going to expect to get a absolutely minimal return at minimum, and that's the risk-free rate. So there's a little bit of a calculation in there that adds in an interest rate aspect to the whole thing. Okay, that's not that big of a deal, to be honest with you. Those two pieces represent the intrinsic value of the option. This is one portion of the price. Now, a second ago, I showed you that 130 strike on Netflix actually cost $8 and some odd cents. So we take out $2.89, subtract that out from the total price of the option, take a little tiny sliver, maybe another 10, 15 cents related to the interest rate, and we've got this big chunk of money that's left. All right, why is that there? In fact, let's actually take a look at those numbers. $2.89. So right now, if I bought this option, it'd probably be about $1.50, or excuse me, $8.50. So $8.50. We know that we've got $2.89 in intrinsic value. That leaves $5.61. And by the way, here we'll take 10 cents off for interest, I guess. It's not really much, but $5.51. So what is that $5.51? That right there is what we're going to be working with mostly. That is going to be one of the biggest drivers of our trades overall. And this is what's called risk premium. So let's think about this. If an option seller just sold you the option for exactly the interest rate plus the intrinsic value, they would never make any money. They have no possibility of making any money. And they still have the risk that the stock could move against them and cause them to lose more and more money. Remember, the higher the price that the stock goes, as Netflix goes up and up and up, the higher the price it goes, the more money that the option seller loses, because that means they have to buy the stock at a very high price and sell it to you at the 130 strike. They know that that could happen. So here's where the interesting magic gets in. They make an estimate of what they believe the risk of the stock going up is between now and the expiration of that option. So in the case of this option right here, there's 10 more days. They believe that if they sell that option to you, that 130 strike call, at $8.50, that they are going to receive more money than it's going to cost them to basically buy the stock and sell it to you for $130. Because remember, they're receiving this money right up front. You're paying them for the right. In fact, you're paying them to give them the obligation to sell that stock at that price. They can't get out of it. They want to get paid for it. So they figure out what is the risk of the stock price moving up deeper and deeper in the money, causing them to lose more and more money. What's the risk of that happening? And how much money would they need to receive to basically protect them against that happening? So that right there is what we call the risk premium. And that is an incredibly important part that's going to drive almost all of our trades coming up, at least to some level. And by the way, this right here is where the idea of buying long calls and long puts starts failing. Because let's think about this. If you were an option seller and you did this as a business, do you think that you would sell options at a price where you basically felt overall you were going to break even? Would anybody do that? Would you go down to the office and say, basically, I'm going to try to make $0 today? Anybody think that's even a smart idea? No. So what happens is this. Not only do the option sellers try to evaluate what they believe the general risks are that the stock is going to move, they also balance off their risks, and I'll show you how they do that in just a second. And they try to build into the prices enough extra money that on average they're going to come out ahead. So if you really want to look at it, it basically comes down to this. Option sellers are trying to get enough money out of the options price that they are pre-pricing in the potential move of the stock. So as the stock price goes up, the options price also increases. It also puts them at higher risk. They know that along that whole process, they are going to have a risk of losing money. They're selling the option to you at a price that they believe is high enough that they're going to walk away from all of those failures and all of those things going against them and walk away with more money in their pocket than you. In fact, they're the ones who are going to be coming out ahead. So now they're building in things into that price that are above and beyond pure risk. It's way beyond just the likelihood that the stock is going to move. What they're doing is they're building into the price of that option the cost of their house, the cost of their car payment, the cost of their health insurance, cost of raising their family and providing for, the family and kids, the cost of that camp down on the lake, the sailboat down at the marina, all of this stuff. They're baking that into the options prices. Now, they don't have free reign. I mean, if they jack the price up too much, nobody's going to buy them. But if they put it down too low, they're not making enough money so that they can actually live a life and have a good life, which is what they do. By the way, I know a lot of these guys. I sat there for years drinking with them. Little bar called the Martini Bar down on LaSalle Street, 400 LaSalle, right across from CBOE. Right after the market closes, they stream out of there and hit the bar. And they need to buy those drinks too. So they don't do that by pricing options at a fair price. They do it by pricing the options at a premium above and beyond what a true fair price is. Now, that doesn't necessarily mean that options are always overpriced. It just means that there tends to be a bias in the market. They can't do it too much. If there's no buyers, or if they've got the price too high and nobody wants to buy the options, then they don't get any business. They don't make money either. There's a balance. They can't go nuts on it. But what they do is when they have the opportunity, they absolutely raise the prices as much as they can to try to get as much premium as they can. And that's how they make their money. Now, Rob, LJ, does anything about that tell you why the buying the long options, the puts and the calls, was probably a bit challenging, or at least over the long run? By the way, option sellers are not necessarily geniuses. They don't have a crystal ball. They don't know what's going to happen next. But they have a lot of experience and they have a lot of understanding of the markets. So, Rob, LJ, yeah, well, Rob, time decay, which we'll dive into even more tomorrow, is just a side effect of what I just said. Because remember this, risk is all about time. If there is 10 days for a stock to move $5, there's a certain amount of risk that it's going to happen. If there's 30 days for the stock to move $5, there's a much higher risk that that's going to happen. And it all has to do with how far past that strike price the stock gets. So time decay is just the price of the options decreasing because there's less risk in the options. And the balance is that, people are paying less, for the options. The value of the options is lower and it decreases over time. But what's happening is that pretty much the option sellers are pre-calculating in what they believe is going to be a likely movement in the stock and charging you for that up front before you even get into the trade. Now, you can certainly win. I'm not saying you can't make money. In fact, I think both of you have made money on trades like that. But on average, what you're doing is you're fighting against a system that's basically rigged against you. Now, that may sound horrible, but it's actually wonderful because in the options market, we get to flip things around, and we get to be the sellers too. And we're going to use that heavily in what we're going to do for trading. What we want to do is we want to understand how that whole price actually happens. And we're starting to right now. How that price happens, how to spot when that price is elevated and overpriced, and then know how to create a trade that actually puts us on the right side where we're participating with the same guys that are overpricing the market. We're riding right on their coattails. And that's when we're going to get some nice advantages. Now, we can't just sell the options by themselves because that creates new problems all by itself too. It creates way too much risk. But we can certainly create different types of trades that take advantage of this. And it works to give us a good portion of that advantage to ourselves and not expose ourselves to the same level of risk. So let's move on. Next, we get into the concept of implied volatility. Now, we actually just talked about implied volatility. You just didn't realize it. Implied volatility is one of the most horribly misunderstood concepts in the options market. And it always drives me nuts when I hear people say this. I mean, how many times have you heard implied volatility went up, therefore the prices, therefore the prices went up? Implied volatility is rising, causing the prices of the options to go up. Anybody ever heard that phrase? You probably have if you've been around the options market. It's tossed around so much. It's completely wrong. Implied volatility doesn't go up, causing the options prices to go up. Implied volatility is the options price. It's the same thing. It's just looking at it from a different point of view. A second ago, we were talking about how an option seller will evaluate the risk in the market. And from that, they will determine what they're comfortable selling the option at to be sure that they make enough money to cover the risks that they see in the market. Well, the risks they see in the market are the stock moving around, the volatility of the stock. So what's really happening here is the market is basically creating prices. And depending on, as risks go up and as people perceive the risk to be higher, the sellers of the options raise their price because they don't want to get hurt. The buyers of the options are more desperate to buy because they need to buy these options to protect themselves against, maybe a major failure in their other trades, or use it like an insurance policy, or like us, using it in a trade. The whole cycle kind of works where risks increase, or the way I like to talk about it is fear, uncertainty, and doubt increase in the market, causes the price of the options to increase. Now, implied volatility isn't separate from this. There is no separate thing called implied volatility. What's happening is, through a little formula, which you really don't have to know how to use, but if any of you are math geeks, you can dig into it. It's called the Black-Scholes formula. And it says that what is the risk that is implied in the option or in the market for the stock based on the price of the options? Because if the options price is really, really high and people are buying the options and transactions are happening, that means the market basically believes that the risk that the stock is going to, go way up or way down is very, very high. It's implying that there is a certain amount of volatility to the price, that the price is going to be, jump around a certain amount. If the market believes that the price of the stock is going to not jump around much and it's going to be in a fairly tight, small range, maybe it's a fairly boring company, or maybe they're just, in a buyout situation, we know what their price is going to be in the future, or I don't know, it doesn't really matter. But if we don't believe that there's a lot of risk in the market, things are jumping around a lot, then the options prices are going to be lower, and they're going to imply a different level of volatility. And volatility is just a measurement of how much the stock moves around. So that's what's happening. The price of the options are implying what the stock is going to do. Now that actually becomes a really very, very, very powerful tool for us also. Now we have to realize what it's taking to get there, which is a bunch of people really, really wanting to make a profit, doing everything they can to raise the price, mixed in with the reality of they've got to keep it low enough for people to actually bother to buy the options from them. Kind of generates a little bit of a balance. Not perfect, but a little bit of a balance. And using Black-Scholes formula, or better yet, just use your options trading platform like Thinkorswim or whatever you happen to use, you can get some really, really useful numbers out of it. And we're going to dig into those tomorrow. They're going to be delta, the implied volatility, theta erosion, vega, how things change. They can tell you a ton about what's going on in the market. So what really happens, implied volatility never causes prices to go up. What's happening is the price is happening, and then we read the price and determine what the implied volatility of the market is. Now, let's have a quick little pause. Everybody, up to this point, I'm sure that people have had a couple of questions, maybe confused about a couple of things I've said. These are all pretty important fundamental ideas to understand. Anybody have any questions yet? And I'm going to go around the room and just have everybody please tell me yes, I've got this, or I'm a bit confused. So love to just see a response from everybody here. Good for now. Yes. Andrea, um, Tina. Okay. One of the other things, especially for the people who are relatively new to options, let me just give you a brief little rundown of what you can expect as you learn about options. Now, even for some of the more veteran people in the group, this is important too. Um, Options are complicated. There's a lot of moving parts. There's a lot of pieces. But they're not impossible to learn. And I'll promise you that we'll get through that. There's going to be a point where everything seems to be overwhelming and just kind of confusing. Accept that. It's going to happen. What I find is this. You get the ideas, the general concepts down. And then as you start working with it and using it, you link the concepts with what's actually happening in your trades and what's going on in the market. And piece by piece, everything starts to fit together until you have a really clear understanding of what's going on. There's a certain point where I see people kind of trip over into almost instinctively understanding the options market. When that happens, it's like a whole world of trading opens up and things become much easier. They're understandable. Your trades are manageable. The risks are controllable. Doesn't mean you don't lose. Doesn't mean you're perfect, but it certainly means that you've got a big advantage in what's going on, and you can beat out a lot of the other people. One of the beauties of the options market is how many people trade in the options market who are absolutely fundamentally clueless. You're making a big step right now to get past that. You don't want to be one of those people because they're funding us. I mean, they are basically giving us money. And Rob and LJ, I appreciate over the years the money that I may have received from you. I'm not sure I beat you on every trade, but it's just without them out there, I wouldn't have been as financially happy as I am. But I don't want you to be those people anymore. So give yourself some time and let this stuff absorb, and you'll get there. So if it feels confusing, just relax and understand that it'll happen. All right. What do we have? Netflix tends to exceed the expected move. Is there a way to play that besides long straddles? Absolutely. As a matter of fact, I would say long straddles are about the worst way to play that. I'll talk about that a little bit. I'll see if I can slide that in before the end tonight. Nope, I do not want you to be the market ATM, Rob. That is absolutely not where I want you to be. So let's figure out how to get past that. First of all, we need to understand what causes you to be the market ATM, which is what we're working on now. And then we're going to figure out how to play the opposite side of that at the right moment in time and turn it into that you are the one withdrawing the money. So we just talked about implied volatility. We get this number from implied volatility. I'll show it to you in just a second. It's a percentage. It's an interesting thing. And remember a second ago I was telling you that we can learn a lot about what's going on in the market by the prices of the options and by basically running them through a little formula, Black-Scholes formula, and getting some certain things out. Now, I tossed around some things, delta, theta, vega, implied volatility, some things like that. We're going to get deep into those tomorrow, and you'll understand those. But first, let's just talk about what implied volatility actually says. All right. Implied volatility is actually a percentage range. Now, everything in the options market works off of probabilities. And there's these things called probability distributions. Most of you have probably seen a bell curve before. And I'm sure that most of you understand what a standard deviation range is. Well, a one standard deviation range is pretty simple in concept. The math behind it can get a little hairy at times, but you don't have to worry about that. A one standard deviation range says that 68.2% of the time, some form of somewhat randomly moving something, doesn't matter. In this case, it's a stock price, will land between this point and this point. Okay, 68% of the time it's going to land in that range. That's a 1 standard deviation range, actually 68.2% of the time. So there's still a chance that the price is going to land outside of that range. Does not mean that you are going to have the stock right between those two prices all the time, but the majority of the time, 68.2% of the time, based on the options pricing, the stock is going to be within this range. Now, let's jump back over to the trading platform and look at these numbers for a second and see what this really means. Here we have, I'm going to jump off of Netflix actually and get to something a little bit further away. Nike, here we go. All right. Here is our options book, all the different expirations, all the different strikes. I'm going to just pick out something that's about 30 days out. And the options, right about the current strike prices that are pretty close to the market right now, the at-the-money strikes, are giving us an implied volatility of, let's just say, an average of about 20%. So what does this mean? The way to read this is that over a 1-year period, so on a date 1 year from today, if the stock continues acting like it's acting right now, there is a 68.2% chance that Nike is going to be within 20% above the current price and 20% below. So that gives us a very, very defined range and a probability that it's going to land there. From that, we end up actually knowing a ton of different things. In fact, with a little bit of math wizardry, which we don't have to do, which is beautiful, because it's nothing like not having to do work, we can actually start to figure out some pretty important things about what the market is actually predicting the stock is capable of doing. So how many times have you ever been in a stock trade and you've wondered, what's the chance of it hitting this profit target I have? You know, let's see, Nike is trading at 53.65. And all right, Nike is generally heading up a little right now, kind of bounced off a bottom and it's heading up. I've got a long Nike trade on and I think that Nike is going to hit, I don't know, 55.50 in, I don't know, the 14th of February by Valentine's Day. What's the odds of that actually happening? Well, we're going to look at these a lot more in depth tomorrow, but I can actually figure that out pretty easily. So I am going to go to the trading book. And actually I have to use the 17th of February, but once I know what the implied volatility is, I can actually figure out the odds of Nike actually hitting my target price, which is what, 55.50? So I'm going to change that to 57.50. I can go over and there's a delta of 10.6 cents. Now we're going to learn about this tomorrow, but this right here basically says that based on the options pricing, all those people analyzing the way the stock moves, how far it's going to move, and all of these different things, they feel there's a 10.6% chance that Nike is going to be above 57.50 on February 17th, the expiration of this option. There's a 33% chance that it's going to be above 55 on February 17th. All of that right there is coming out directly from the price of the options. It's all building in the risk and the probability of the move right there. So we can figure out what we believe the odds are that something is going to happen. Better yet, we can also design trades around this to basically jack up the odds of success from a 50-50 shot that you've got in a stock trade to something that's more like a 70, 80, maybe 90% probability of success. You've got to understand what you give up and what you get when you do that, but you can actually create trades that have a very, very, very high probability of success by using those basic concepts. Don't know what a standard deviation is. All right, let me see here. see if I can describe this, Andrea. It's a hard one, actually. It's a statistical concept. Imagine, I'm going to use the drunken walk example. Imagine a drunk person walking out of the bar, and they generally want to head in one direction. But as they're walking, they stagger a little bit to the left, and then they stagger a little bit to the right, and then they stagger a little more to the right, then they fall back to the left. And this person is drunkenly going back and forth with no particular aim except to go forward. One person doing that, you know roughly how many steps each time they might take left and how many steps they might take right, but you don't know what the order of that's going to be. You don't know if they're going to, stand up, stagger further left, stagger further right. Just understanding how they move, you could say with fairly decent certainty that that person is going to end up between that light post off to the right and that light post off to the left with about a 68, 70% odds. Well, it's just mathematically analyzing how they're staggering back and forth and how big those moves are. You can get a pretty decent idea of where they're going to be. Now, take 1,000 of those people and let them all independently stagger along and go up and down and up and down and left and right, and then mark off where they land between each of those poles. Now, if they were originally facing right towards the middle of those two poles, the majority of them would have landed right in the middle. The most of them would have been there. Some of them would have been a little further off. There's a lower probability that they're a little bit off to the left or the right of the middle. And then you get further and further down, and there's a lower and lower probability of them landing either on an extreme right hand or extreme left hand position. Let me actually pull the chart up. You see this curve right here? This curve is a bell curve, and it's called a normal distribution. And this is what describes the odds of something that is doing that drunken walk. It describes the odds of where they will land. If everyone starts out pointing at 50, the majority of them are going to land right near 50 because some are going to shift up, then down, and on average, they'll land about here. But some of them are going to come over and they're going to be closer to 40. And some of them are going to be closer to 60. These are your two light posts. In concept, this is the same thing as the stock market. Now, as much as we want to believe we can predict where things are going to go, really, it's very difficult. I mean, picking out exactly where a stock price is going to go is hard. Well, you get the same process. It's lower odds that a stock is going to be way, way, way up here or way, way down here. Oops, sorry. And a lower odds that it's going to be way, way here, but very, very high odds that it's going to be very close to where it is now. Well, when you're looking at this, you can't just say, I have a 100% chance of it landing between 2 points. You need to have a narrower range to figure out what the odds are. And this is where one standard deviation comes in. Now, the actual reason for them creating one standard deviation at 68.2%, there is one. And I really should go and look it up so I can repeat it to you. But the easiest thing is 68.2% of the time, if things are kind of randomly moving around, what is the range where they're going to land that percentage of the time? How often are they, or how wide is the area that you would have to have that the 68.2% of the possible outcomes land in that range? And that's what a one standard deviation range is. That's also what an implied volatility is. It is saying that over a 1 year period, a implied volatility of 20% on a $50 stock means that 68.2% of the time, the stock is going to be between $40 and $60. 20% of $50, that's $10 up and $10 down. Now, As you get further and further away, there's a lower probability of that happening on both sides. It can, maybe it goes way up, but there's a lower probability of it being successfully up there. It could go way down, but there's a lower probability of that happening. Greatest probability is in the middle here. They use that to figure out options pricing, because what an option seller wants to be doing is basically making money the majority of the time. They use this formula to, they use a concept of this formula to figure out what the price is. And because of that, we get to figure out what the market believes the possible price movement is. Now, without doing an entire lesson on statistics and things like that, hopefully that gets the basic idea across. Honestly, if you just have a general idea of what this means, you don't need to know every little detail about, statistics and probability models and things like that. The platform is going to do 90% of the work for you. Understand the idea that an implied volatility says what is the range over a one-year period that I expect the stock to land in 68.2% of the time, if it was just tried time and time and time again. Does that make sense? So did that make any more sense, Andrea? Okay, so there's the core idea. That's what you've got to know. Other than that, you can work on the math if you feel like it, but you don't need to do it. All right, so we've got that basic idea down. Now, does anybody have any other questions about implied volatility? Because this is going to be one of our, one of the tools we use to figure out where we want to set up trades and where we can get really good edge on the trades. By the way, when I say edge, what I'm talking about is the idea that you can get an advantage in a trade. Just like when you walk into a casino, if you are the person who walks up to the slot machines, puts those quarters in time and time and time again, you have a chance of winning any one of those, any one of those pulls of the slot machine. You can potentially win. But the reality is that the casino has built into that game an edge on you. On average, on the long run, they're going to win. They don't build those great big buildings to lose to you and I. We want to figure out what's the right way to look at the trade to figure out where that edge is. And a big chunk of that comes down to implied volatility, because that tells us how much they're paying us to take a risk. And we'll dig into that a little bit later, but if you're being paid a lot to take a risk and you evaluate that risk to be fairly low, you just found a trade where you can get a very good advantage, because you want people to think that they're winning when you're actually getting the odds on your side. And that's what we're going to be looking for. Lou, actually, the implied volatility, let's talk about that. And yes, I'd be happy to, no problem. Tell you what, Lou, do me a favor at the end of this, remind me about that and I'll give you a link and you can download the implied volatility indicator. A couple of things to realize, and Lou just gave me a good chance to talk about this. You're going to see implied volatility in a bunch of different ways. Tina, answering your question, are we looking to always be close to 20% implied volatility? No, absolutely not. As a matter of fact, volatility is going to be all over the board. And you have to get to the point where you realize what it means and how you're going to get an advantage over it. What you always want to understand is the implied volatility you're looking at in the options underpriced or is it overpriced? And that right there is going to define how you make a good portion of your trades. How do you design a trade to make it work for you? And a lot of it's going to come right down to that basic idea. Is implied volatility underpriced and likely to go up, or is implied volatility overpriced and likely to go down? Or can I get a credit based on an exceptionally high implied volatility and not take much of a risk to hold on to it? I mean, that's what we want to get to. Now, when we're looking at implied volatilities on the trading platform, you're going to notice a bunch of things. First of all, I'm looking at implied volatility on the options chain itself. Now, this is the most accurate implied volatility. Honestly, implied volatility doesn't exist except for this location. Every option out there has a price, and based on that price, and by the way, they normally are using the bid-ask midpoint on the option to figure that price out. So somewhere between 65 cents and 66 cents, 65 and a half cents probably. This 55 strike Nike call option, that's the price. And they use that number to calculate out the implied volatility. Really just using that probability distribution we talked about a second ago and saying that if the person was pricing their options at this level, then that means they must expect this much price movement to potentially happen in the future. Okay, so we have an implied volatility here. And you'll notice that these implied volatilities, as they get further and further from the current price of the stock, actually start changing. They can get big, they can get pretty outlandish. You'll also notice that the bid-ask spreads can get pretty wide. Probably don't want to be playing out here. There's some things that are going on with this. Mostly it's because of the bid-ask spreads, and the other thing is that the math isn't always perfect. So realize that everything we deal with in options is kind of an estimate of things. Now, there's a second place you're going to see implied volatility. And Lou, I think this is what you were talking about. It's this right here. This line. Now, by the way, Lou is asking about this implied volatility indicator that I have. I'll give everybody a link to this. You're welcome to download it. Happy to have you use it. But one of the numbers in it is implied volatility. Honestly, I just use the implied volatility from Thinkorswim. But you have to realize what this number is. There is no such thing as implied volatility for a stock. People say this all the time, but there isn't. There is no such thing as implied volatility for a stock. There is implied volatility for the options on that stock. And if you want, you can create a little calculation that averages, well, let's see, let's go back to the options book. Averages different expirations, got the 20th of January, 27th of January, 3rd of February, and averages out different strike prices out from the at-the-money strike. And if I create a formula, add all of these up, I come up with a number. And that number is implied volatility. Every single brokerage has a slightly different formula for doing exactly that. And this is the tough part, Lou. There is no right or wrong. There's just how do they do their formula. But how they do their formula will dramatically affect how the implied volatility shows up on your screen. Thinkorswim does their implied volatility formula very, very differently from TradeStation, from Options House, from Options Express. Everybody's got a different formula. And so that makes it a little difficult when you go platform to platform. Things don't look exactly the same. They look a little funny. Now, Lou, to answer your question from before, I don't actually have a different implied volatility formula, but I do definitely have a different historical volatility formula. Now, normally I usually leave this for a different part of the session, but I might as well get into this because this is probably a good time to talk about this. There's different types of volatility, and all of these types of volatility are very important for us. They all have the same number. We're all talking about a percentage range that the stock's going to move over a one-year period. Or there's a probability distribution and a 68.2% chance it's going to land in this range 1 year from now. Now, implied volatility is based off the price of the options. There's another one that we use a lot called historical volatility, and you'll see that as the red line down here. Now, Lou, the reason that's the one that I actually rewrote yes, it's very important for scanning for trades. And let me explain that. That's the one that I used a different set of formulas for and rewrote because actually the historical volatility measurement that the brokerages use is horrible. It's terrible, and I'll explain that in just a second. So let's talk about what I would discuss as the three forms of volatility. We already know about implied volatility. Historical volatility is actually measuring a stock, measuring the price movement, and based on what it's done in the past, determining what it might do in the future. It's a measurement. It's actually looking at the way the stock has moved. The third implied volatility is forecast volatility. So this is the way I like to describe it. Think about it as a car driving down a road. And the road conditions can change a little bit, but you took a measurement and you knew when a car passed a certain point back on the road, and you know quite well what that road was. It was a little bumpy, a little bit twisty and turny, blah, blah, blah. And you know how far that car has gone, and boom, you measure it, and right there, you know how fast it's gone. That is measuring the historical volatility of stocks. You're measuring how much that stock is moving around and what speed it's moving. It's basically measuring miles per hour for a stock price. Now, this measurement doesn't care what direction that the stock is moving. It could be moving up, could be moving down, could be jumping up and then jumping down. Doesn't matter. What's important for it is how quickly is it doing that? How extreme are the movements? Now, that right there gives you a number that says if the stock were to continue moving at the way it's been moving over X period of time, maybe 45 days, maybe a year, maybe 3 months, 4 months, I don't know. Whatever the period you want to measure, if the stock continues to move the way it's been moving, then the future volatility for this, the range over the next year, is this. So let's actually look at Nike for a second. I have an implied volatility of 22%, but my historical volatility is 17%. Okay, now that actually ends up being important. Very, very important. All right, so to continue on with the analogy, historical volatility is just measuring the speed that the car was driving back over this patch of road, understanding what was going on in the patch of road, and using that to generate your number that says, based on this, this is what is likely to happen. Now, forecast volatility is taking that number you just got from historical volatility and then thinking a little bit about what's going on in the world, what's going on in the markets. Is there anything that's going to cause the markets to be more crazy in the future? Is there anything that's going to cause the markets to settle down and maybe be more boring in the future? Is there anything that's going to dramatically affect the nature of the way the stock is moving? Well, if there is, you put little adjustments. You tweak what the historical volatility was. It's like if I knew that the road ahead was smoother and faster, then I would take the speed that I saw the car driving over the last 5-10 miles, and I would say that it's very likely that this driver, based on the speed they've been doing, is probably a little bit of an aggressive driver, and therefore over this nice, flat, clean stretch of road, they're going to drive even faster. I would estimate that their speed is going to be a bit higher. Or maybe I believe that the road ahead is going to be rocky and have lots of stumbling blocks and not allow the driver to drive as much. Therefore, I would tune my forecast volatility down. It's an estimate of what I believe is going to happen. Now, once you have those numbers, you start to have a fairly powerful tool, because you are now able to compare that directly to implied volatility. By the way, implied volatility, if you really want to know with the car analogy, is figuring out roughly how fast the car is going to be driving by how much they pay off for their car insurance. That's actually a pretty accurate description of exactly what implied volatility is. It's determining how crazy of a driver they are by how much their insurance company charges them for their car insurance. Now, why is this important to us? Because we get paid for risks. Options trading is all about risks. Now, the beauty of options trading is we get to control risks. So if you had your choice, if I had a trade where I could either be the person who got paid a lot of money to take a low risk, or I got paid a little bit of money to take a high risk, which person would you rather be? Would you rather get paid a lot to take a small risk, or would you rather pay a lot to take a high risk? Come on now, this isn't that hard. Let's get some answers here. All right, seriously, low risk, high reward, exactly. You want to be paid a lot of money to take a small risk. Or the flip side is you want to pay a very, very, very little amount of money to take a moderately high risk. But this is actually what's going on in the options market right here. Implied volatility roughly translates into how much if you sell an option, implied volatility translates into how much money you're getting paid to take a risk. The risk is, does the stock move? Does the stock move against your strike? Well, the risk relates directly to historical volatility. So if I can find an option where I can get paid a high amount of money to take a low risk, I can actually get into a trade that gives me a really, really good edge in my trade. I get a nice advantage. Now, it doesn't necessarily mean that every time that's going to work out to be a perfect trade and I'm going to win. But what it does mean is that over the long run, if I take trades like that over and over and over again, getting the edge in my side, on average, I'm going to be making more and more and more money. Now, Rob and LJ, what ends up happening most of the time, and this is what was killing you guys, is when you buy a long option, you're the guy buying the low movement and paying the guy you're paying the guy for the high risk, while actually only getting the advantage from the low risk, from the low price movement. You wanted price movement, but you were getting very, very little price movement relatively compared to what you were paying for on the option. You're paying for more price movement than you were ever going to see. Now, sometimes you guys were winning, and by the way, I'm using you as a good example. I'm really trying to do it as I'm not trying to be a jerk about anything, but it gives me a real live discussion point about why this is important. You are paying the high amount of money and only getting the small value. We want to take it and flip that around, and we want to create situations where we're the ones being, receiving the high amount of money for taking the low risk. Now, to do that, what we do is we do combinations of options together. We mix options up. Because you can't just sell the options. At least it's very difficult for us to do that. The margin is too high. The risks are too high. Overall, there's too much of a chance that we could blow our account and lose everything. But there are lots of ways that we can tweak this so that we actually get an advantage. And this is where we're going to be going. Now, and this is really what I wanted to get into today. I wanted to get this general idea in people's heads. Now, there's a ton of reasons why options are overpriced, and some very fundamental reasons, to be honest with you. A big portion of the options market, the buyers in a big portion of the options market, literally are not buying options to make money. It's a weird concept. Why would you ever do a trade where your intention wasn't to make a profit? LJ, I'll tell you what, just to be fair about this, a lot of the teaching that I do and a lot of the education programs that I've got are really teaching people about, how to avoid the mistakes that I made in the past. There was a point in time where I didn't know this stuff, and man, I got slammed on stuff. It just absolutely killed me. I made stupid choices. Luckily I've managed to control my risks enough that I survived to this point, and I get to share it. But it's you get a choice when you're learning this stuff. Do you learn the expensive way, which is in the market and paying other people in the market to teach you a hard and harsh lesson? Or do you learn from somebody else who's done it, failed, understood it, comes back and can show you how to avoid that minefield? So yeah, and I appreciate being able to use your trades, or what you guys were talking about as a kind of point in the whole thing. Yep. Yeah, absolutely. By the way, the hedging rate there is actually one of the reasons why options prices are generally overpriced. A big, huge portion of the options market is this thing called long-short hedge funds. Long-short hedge funds are an interesting little animal. They're a massive portion of the overall stock market. And they've got this very interesting goal. They create a portfolio of stocks, and they mostly have to be in stocks because that's the one place where they can actually sink enough money to do this in. They do a portion of their portfolio in a bullish way, and they also balance that off with a portion of their portfolio in bearish. Now, each trade that they take, investment that they make, is based off of a lot of analysis and understanding that this stock is likely to be a bullish stock. It's a good choice as a bullish trade. And this stock over here is likely to be a good trade as a bearish trade. It's a good bearish position to be in. Now, you mix these together in a portfolio, and an interesting thing starts happening. In fact, this is going to be the core of the idea that we're going to get into on Thursday about portfolio management. What happens is when the market is working normally, the bullish trades are winning because they're doing what they were supposed to do. And the bearish trades are winning because they're doing what they were supposed to do. There's nothing crazy driving them around and changing the way that they're working. So you're making money off the bullish side and the bearish side. When the market does something crazy, like let's just say that it goes into a fairly large correction, what happens is no matter how good your bullish decisions are, they're still going to move backwards against you, and you're going to start losing on those. But the nice thing is your bearish positions are very, very likely to start to make money faster. Now, that extra profit you're seeing in your bearish positions offsets some of the loss that you see on the bullish positions, reducing the overall risk of the portfolio. Now, what does this have to do with options? I mean, where am I going with this thing? Well, the goal of most long-short hedge funds is to sell their services to massive, massive institutions. CalPERS, the California Pension Fund, Yale Foundation, Harvard Pension Fund, Harvard Foundation, all of these different places, sovereign wealth funds, the Saudis invest in these things all the time. Their goal is to basically preserve the wealth and get a little bit ahead of inflation overall. Their goal is not to make 10, 15, 20% in the market this year. Their goal is to be ahead of inflation in a very, very safe way. So that's where these long-short hedge funds come in. Long-short hedge funds primarily make their money off of fees. That you've heard that 2 and 20. Well, the 20%, which is 20% of the upside, sounds like a really cool thing. But that's not where they make the core of their money. They make it off the 2% fee that they charge on assets under management every year. So what makes them more money? Not losing customers. So they're willing to take some of their profitability and invest it in options, long puts and long calls, just to protect their overall portfolio from varying too much and scaring their customers off. They're literally going in and they're buying options with little to no interest in making money off of them. They just want to reduce losses if things go bad. So that right there is one of the drivers of overpriced options. Plus, when you get right down to it, fear and uncertainty makes people make bad decisions, and they're willing to spend more money than they should on options. People don't understand how options work, so they buy lots of those long puts and long calls, pushing the price up on them again, overpricing options. Huge amounts of pressure basically pushing options to a higher value. And that means that you're being paid more to take a lower risk. And that's what we're looking for in a lot of situations. On this chart right here, let me just scale it out a little bit. I didn't necessarily pick this out because of this, but yeah, look at this. The red line, which is historical volatility, it's a little hard to see on here, but you notice this? This is the way that the stock has actually been moving over these periods of time. And this green line is what it's priced at. The options are priced at. So they're pricing in sometimes twice as much movement as what's actually happening in the market. Now, it doesn't mean that it always is higher. There's moments in time where it pokes its head below this, but in general, yeah, it's higher. So this is one thing we look for to basically build out our edge in the trades. Now, that right there is really a core of what I wanted to teach tonight, what I wanted to get to tonight. There's a couple of other little things that I wanted to poke around with, just, get some basic ideas down and things like that. But once again, and please, when I say these things, I'm really expecting everyone to just give me a I got it type of an answer, or actually give me a question. How are you feeling on this concept? Because if I can teach you this one concept tonight, we've just made a huge step forward for everybody. Trades are just using what I'm looking at right now to turn what you think is going to happen into profits. But if you don't understand this, you're not going to know where to look for profits. Everybody good? Any confusion? If you do, ask the questions. Okay. All right, everybody else good? Andrea, Tina, KB, everybody? All right. So let's go play probably. Actually, LJ, that was the moment when you had the best chance of making your trades work. And by the way, it doesn't mean if we have this inversion where we've got implied volatility way above historical volatility, it doesn't mean you can't win. That's not what it means. It means that the odds of you winning, the probability of you being successful is lower. Now, on any one trade, yeah, you could have swung it out, knocked it out of the park, and you could have made a ton of money. Run down to the pub, told all your buddies that you kicked ass today, and rightfully could have been proud. The problem is that on average, if you're playing it the wrong way, you're going to be in a situation where you're losing more money than you're winning, even though once in a while you do win. Never think that having a perfect setup means you're going to win. It just means that the chance of winning is higher, and in the long run, your profitability is going to be better. But you can always lose on any individual trade. Yeah. All right, let's dig in to a couple of different things. Now, we've been talking concepts so far tonight, and I know that can get a little dry. Let's take a little bit of time and dig into actual, playing around with some options and seeing how things work. So, first of all, I want to show you something in the options market that actually controls a lot of things, and I'm just going to touch on it. It's called put-call parity, and it allows us to do a bunch of things, but the real reason I'm showing it to you is because it actually makes the entire options market work properly. So let's do this. Remember, every option, the majority of the price is based off of the risk that the seller is taking when they when they sell the option to somebody. Now, if I was an options seller, now this isn't quite called parity yet, but if I was an options seller, I would do everything I can do to get the greatest advantage in my trade possible. And I also know very clearly how options are overpriced. So if I wanted to sell an option, let's say I'm going to take a Nike February 17th expiration and sell it. And I'm going to do a 5250 strike put. Now this is, let me see, slightly out of the money. And I'm going to charge about somewhere between 72 and 74 cents. So I'm going to sell this. Now, right now, I have roughly 72 cents in my hand to offset any losses that I would get if Nike were to go down in price. Now, I've kind of calculated this out on a couple of things. I think my odds are good. You know, maybe Nike goes up, maybe it stays flat, but every cent that the stock price goes below 52.50, as it drops down and we get closer to the expiration, what's happening here is I am basically having to buy stock for somebody at a higher price, and I'm going to basically liquidate it on the market at a lower price. And buying high and selling low is never a good thing. Every cent that the stock is below 52.50, I lose money. Well, I've been given 72 cents up front. And that means that my break-even point in this trade is not 52.50. It's actually 52.50 minus 72 cents. All right, so let's see where that is. 52.50 minus 72 cents is, let's see, 52.50 minus 72 cents is $51.78. All right, let's go back to the chart. Take a look at Nike. And so we have an option that I just sold that expires in 30 days, 31 days. And $51 and 78 cents. Okay, and let me zoom in on this a little bit. So, as long as this stock, Nike, stays above this, I'm pretty happy. I'm going to walk away with my whole 72 cents, which multiplied times X is probably a lot of money. Great. Now, if I just took that trade all by itself, there's a problem with this trade. This is why we don't take this trade. It's actually a pretty good probability that that trade would be successful. And the risk-adjusted reward on it is pretty darn good. But we have an issue. See this? Oops. All right. You see this line right here? We would be making our 72 cents in this trade as long as basically Nike stays above 52.50. As soon as it passes that, at the expiration, we are on this line down, and we would be losing money. Our break-even point is 51, what is it, 51.78, something like that. And then, if Nike goes below that, I am continuing to lose money down, 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 and down. Now, the problem is, this doesn't stop at 3,000. And by the way, this is a tiny trade. The risk on this trade ends up being pretty darned outrageous. You'll see it actually going down to $20,000 loss and more and more and $40,000. If something were to happen and Nike were to, I don't know, become delisted, they were to be accused of accounting fraud, who knows? I don't even know what it is. We have the potential of suddenly having Nike drop way down. And by the way, I've had this happen to me before. Not on a naked short trade, but on another trade that had a fairly high level of max risk. And I got slammed. The company was a Chinese company. It actually got delisted for accounting fraud. It basically counted as a zero price stock. I lost every possible cent in that trade. You don't want to do this. By the way, the brokerage does not want you to do this. This is a naked short. A naked short, they're going to charge you roughly I think it's between 10 to 20% the face price of the stock, not the option, the stock as your margin, which means you're going to be paying a massive, massive amount of money to be putting this trade on and only be able to make a very small amount. So right off the bat, not a good trade. Now, let me show you how the market makers do this. The market makers are pretty slick. First of all, they've got a lot more ability to jump in and out of trades than we do, so they can do dynamic hedging and keep their portfolios balanced. What they do is this. They turn around and almost the same time that they sell this 52.50 put, they go ahead and they sell a 52.50 strike call. Now, they just received credit on both sides of the trade. I received about $1.95 on one side and about 74 cents, about 73 cents on the other side. Between the two, they have $2.68 in credit. Now, let's go back to the chart. The red line represents the place where we would be failing if we bought this one, what was it, put, or excuse me, I sold a short put roughly at the money, 52.50. So if the stock dropped below this, we would be losing money. What the market maker just did is something kind of cool. They went in both directions. And they received a lot more money than we did. In fact, current price is, okay, the strike price that we've got is 52.50. We got $2.68 minus 268. So our new break-even point on the bottom is, what did I say, 49.82. Okay. So we now have all the way down here to basically be safe. Now the problem is that we've also got the other side of the trade. And that means that I've got to do 52.50 plus $2.68, 55.18. Now this side's not so good, but taken together, they're not bad. Now the way they manage this is they create this nice, great, big, huge area over which they can win. Now they can only lose on one side at a time. You can't lose on the put side and the call side at the same time, but they have twice the credit in, and it creates a much wider range over which they can make money. Now, am I saying run out and do this trade? No. Major problem with this trade is that you now can lose in both directions, and if there's a big gap up, you could lose that way too. They have other tools for managing that, and they're actually balancing off their risks and dynamically hedging in a bunch of different ways. So what do we do to turn this into a decent trade? Well, we use the options in a slightly different way. So I'm going to just say that I'm going to do a bullish trade, and I want a fairly high odds, fairly good odds of success in this thing. Let me see here. All right, I don't have a really good strike to work with. Hold on, I'm just going to shift over a little bit. There we go. So I'm going to do a bull put spread. Same thing, I'm selling. Now once again, I'm trying to get the advantage on the trade. By selling the option, I am basically taking the same side as the market makers. The market has shown me that it is overpriced as far as implied volatility is concerned. So I'm being paid a lot right now to take a moderately low risk, but I can't just sell the contract all by itself. For a lot of reasons. Number one, it would be an extremely expensive trade. It would ruin my P&L. I would just make very little return on investment. What I'm doing is I need to give up some of this advantage to make some of my risk go away, but radically reduce my cost. So what I do is I go a little bit further out. So here I am, 51.50 short. At this point, I'm just going to do $2 away. I'm going to go long. So I took some of the credit I received here and I spent it to protect myself. Now, here we have one of our basic, simple, straightforward trades. This is one of the more basic trades that you'll get into in the options trading. It's called a bull-put spread. Now, I'm not going to go into every little detail of how this all works, but the basic concept is fairly simple. The strike I'm taking here, 51.50, I receive a credit for. I have a spread, the difference between 51.50 and 49.50. This right here represents the max amount of risk that I could be possibly taking on the trade. This is a $2 difference. The most I can lose is between 51.50 and 49.50. And that $2 is actually offset by my credit. I received 21 cents. My goal on this trade is to let this trade go till roughly February 10th, expire worthless. And by that I mean I don't have to pay anything to have the trade go away, and I keep the 21 cents in my pocket. Now that 21 cents is actually times 100, so that's $210 times how many ever here. I've got 10 of them, so $2,100. Did I get that right? No, excuse me, $21, $210. But let's take a look at the overall trade. By the way, we can scale this up and down extremely easily. The trade itself is going to cost us a certain amount of margin. Margin is based off the risk. Basically, brokers need to protect themselves against you doing something stupid. So they charge you what they believe is the max risk on the trade. $2 minus 21 cents. You get charged $1.79. Now, remember, this is options. That's times 100 because it means 100 underlying stock. It's $179 times 10 contracts, so that would be $1,790. We can make 21 cents credit with 21 cents credit times 100, that's $21, times 10, 210. So we can make $210, $210 divided by 1790. Okay, my calculator skills are failing me. 210 divided by 1790. So we can make just shy of 12% return on this trade. And the trade exists between now and when these options expire. So this is the max we can make on this. Now, you've got to understand that the max risk we're taking on this is $1,790. So right off the bat, I always get hit with the questions of, why am I taking a trade where the max I can receive is a small amount and the risk I'm taking is huge? Let's look at that in just a second. So I can make an 11%, 12% return between now and February 10th, which is 24 days from now. So let's figure out what that really means. And let's put it into perspective here, because the reality is this is actually a lot of money. So divide by 24 days, I am making just under 0.5% per day in the market. To put this into perspective, if I was taking this trade over the long run, if I had a bunch of these trades continuously going all the time and returning roughly the same amount of money, 0.5% per day, and I was able to continuously keep that going all the time in my portfolio, that's the potential for making 178% return in my portfolio a year. So right off the bat, don't scoff at the $210 for risking $17.90. But let's also look at the reality of this. It's still not a good risk-reward ratio. Why would I want to risk $1,700 or $1,800 almost to make $210? Well, because of two things. One, the strike I took, what was it? 51.50, had a delta of about 21. Now that actually translates into, we have about roughly an 80% chance, slightly under an 80% chance that the stock is going to be out of the money or above this price at the expiration of the option. Now, this isn't counting any kind of direction. This isn't counting any kind of prediction of where the stock is going. It's purely based on how much the stock moves. Now, if we pull into this a little bit of knowledge about what direction the stock is going and where it's heading, we can actually increase the probability of being successful on this. So if we're comfortable that Nike is going to maintain this trend for at least a little bit while longer, every dollar that this moves up, it creates more and more distance between us or the stock price and the short strike on our trade where we would be losing money. That means that we're actually capturing more of the money and we're getting safer and safer. So that's one part of the trade. The other part of the trade is just the pure probability of success. But the third part of the trade is realizing something else. We are being paid, and all of these odds, that 78, 79% chance of success, is being driven off of implied volatility that is significantly higher. In fact, it's 22% implied volatility compared to 17% implied, or 17% historical volatility. We're being paid a much higher rate than the risk actually is. So what you're not seeing behind all of these numbers I was flashing up there is the fact that the odds of success in this trade is not really 79%. It's actually much closer to about 86 to 87%. In fact, we can pull a couple of numbers together and get a true odds on that. If we believe that the forecast volatility is a relatively good indicator of the future volatility, or the historic volatility is about the way it's going to trade in the future, what we're actually getting is a trade that's got a very, very high probability of success. We're using that understanding of the pricing of the options, and basically everything I just did there was all around getting us lined up to the way that the options market is overpriced so that we get that edge. We can still take that bullish trade, and we can ride that direction the way you guys want to do the trade. What we're doing, though, is we're changing the trade so that it gets us the edge instead of the option seller the edge. And that's what we're going for. Tina, when I say to sell, is that sell to open the trade? Yes. What we're doing here is we're creating a net credit trade. We're basically receiving more money than we're spending on the trade. We're receiving money for our short option. We're being paid because we're basically selling a short. We're selling an option to somebody. They are the one getting the right from us. And then we're going out and we're buying a less expensive long option, which does have a little disadvantage, but it's got a small disadvantage compared to our big advantage on selling the short option. So the short option gives us a big advantage. Our protection and our controlling option basically takes away a little bit of the advantage, but at a very low cost and a small amount. And between the two, we end up with a trade where overall we're riding on the same advantage that the option sellers are creating, and we're creating a trade with a greater probability of success. So going back to LJ and Rob's trading that they did, using you guys again for this, if you had have been using trades a little bit closer to this, and by the way, there's a world of different trades that we can work with that gets us advantages in dozens of different ways. This is one of the absolutely most basic. If you were using something a little closer to this, your odds on success would have been much higher. You may not have been knocking out of the park when you won. You'd still be making moderate wins, those 11% in 12 days or 24 days, but you would have been getting it much more consistently. You would have been winning far more often than you would have been losing. The money you brought in would have been significantly better than the money you lost, and overall you would have been much more financially better off. And this is where we're going to try to build our edges, build our advantages in the market. Is there a way of ending up having to buy the stock to give it to the person who bought the contract sold? Yes, there absolutely is. And you do have to be aware of that. You have to be careful. Anytime you are in the money on a short option, there's a chance that somebody on the other side may choose to basically call the option in and use it, and you have to deliver. Now, realize that you're being paid at that point for those options. It's not like you just have to come up with stock. They're giving you money. You know, whatever the face value or the strike of the option is, you receive that. So it's not like you don't have any resources to buy the stock. The problem is that you end up getting kind of stuck in a position, either short or long, and if you don't close it out quickly, it can be quite a large position and create some extra risk. We want to avoid that. We'll dig into, you know, strategies for avoiding those situations, and those are definitely things to think about. It's called an assignment. Now, honestly, Rob, the odds of getting assigned they're not non-existent. And as a matter of fact, I'll pretty much guarantee you that at some point in your trading career, you will get an assignment on an option. Now, if you're ever short an option, there's always that risk. But they're few and far between. And bluntly, anybody who executes their long option before the expiration is financially making a very, very poor financial decision. They're giving up a lot of value to do that, and it's just kind of dumb. Rob, how do we get out of this trade? Sure, absolutely. In fact, this is a pretty simple trade to get out of. By the way, for those of you who are going to be in the tactics sessions next week, we go deep into every single one of these. There's a good dozen different approaches that you can use by combining options together to get different advantages in the market. And there's, you know, some can give you huge profits. Others, you know, with low probability, some give you small profits with high probability. Some take advantage on changing implied volatilities. There's dozens of different ways of doing that. If you're not in the tactics course next week, you may want to consider doing it. I'm sure that if you call up your sales rep, they'll find a slot for you. Now, let's take a look at doing what you just said, closing out this bull put spread. Here I am. I have a February 10th expiration, 51.50 short, 49.50 long bull put spread. And if I go over to analyze, oops, nope, I need to go back to trade and then analyze. Okay. Let me get rid of this. Here's the trade. Now, let me clear out some of this stuff so it's a little bit clearer. All right. This right here is the current price of the stock, $53.65. This is Nike. This blue line is the P&L at the expiration of the trade. So we received 21 cents, which is actually $21 per position that we put on. For every one of these pairs that we put on, we receive $21. We get that right up front. Our goal is to keep that $21. We do not want to spend it. Now, to keep that $21, it's simple. All we have to do, well, I say simple, but it's trading. All we have to do is have Nike stay above 51.50. As long as Nike does that, then we walk away with a profit. Now, currently, Nike is trending kind of gradually up. And if I were to assess this right now, in fact, I would consider this as a trade right now. Let me be clear about this. I don't have this on as a trade. But I would seriously be open to doing this trade. Now, we've got a lot of things in our favor. We've got a decent amount of implied volatility. We've got a lower historical volatility, which means that this price movement really doesn't have a lot of energy in it to whip back and hurt us. We've got a good solid trend in the direction we want. I've got plenty of room between the top of this, and there's nothing significant in terms of a resistance level or anything like that above this. I mean, you could kind of look at some things as a potential resistance up here, but I really don't care. If I hit 55, I'd still be in such great shape on this trade that I'd be very happy. Remember, I only have to stay above 51.50. In general, overall, this looks like a good trade. So to win, what do I need to have happen? I need to have Nike stay above 51.50 from now until, let's see, February 10th. And that didn't, oh, February 10th, 2017, sorry. These years switching, they always get me. There we go. So let me delete this little line. Delete this. Delete that. This is 51.50. All right. So as long as I can stay above that from here to here, I make my full profit, that 11%. Now, how do I actually do it? Actually, it's simple. I do nothing. I absolutely do nothing. In fact, that's my goal, is I want to let these go until the point where these options don't exist anymore. The day after this, those options are worthless. They mean nothing to anybody. And that's exactly what I want. I want to be paid for the option, and I want to keep every cent till the very end. I don't even want to do another transaction. I don't want to close the trade. I don't want to do anything. I just want to walk away and keep my money. After this point, they have no right to do anything that would affect my profits. I walk away. I get all my margin back, I get my profits in my pocket, and I am happy. Beauty of that is if that trade works out, I don't even have to pay commissions on the exit, which is a good thing. Now, let me be clear about something. This is just one form of a trade. You know, there are lots and lots and lots of different trades that we're going to explore and we're going to be looking at. But it gives you the sense of how this whole thing fits together and how it works. And that's what I wanted to do. I wanted to get that basic concept, that basic idea in your head right now. So everybody who's here, do you see in general what's going on? Ask me questions. This is called a bull put spread. Rob, can I get out? Do me a favor, Rob. Can you please do me a favor and put your send to everybody as opposed to private? Can I get out if I wanted to if it starts going against you? Absolutely. And this is what you've got as this is why it's a trade. Let's take a look at the P&L again. Let's go back to the Analyze tab. Now, you see this purple line? I was pointing at the blue line at first. Now, the blue line here represents the P&L chart or the P&L profile at the expiration of the option. So this is looking at February 10th. But we have to live in a reality that includes days between now and February 10th. We can't just pop, poof, have it February 10th and have this thing expire worthless and let us keep all of our money. The purple line represents the P&L, depending on the price, between now and then. So if the stock goes up, even if it were to go up today, we're actually almost instantly making money. We will see a profit in we'll be locking in a profit. Now, what does this really mean? It means that at that point in time, the value of the options, both the short and the long, are degrading towards zero. And if we felt like closing this trade, we could buy the trade back to close it for less than we received for the credit up front. So if I had the chance to buy this trade back for 10 cents to close it out, my profit would be the 21 cents credit I received in the beginning minus the 10 cents that I had to spend to close the trade. Now, I want to avoid spending money to close the trade if I can. There's times when we will do that, but for this trade, this very simple concept, I want to avoid that. I would like it to just go to the expiration and have everything expire at zero. That's the equivalent of buying the trade and closing it for zero price whatsoever. I keep all 21 cents. Now, the reality is this. If the stock Nike were to suddenly start pulling back, I am on this slope right here. And as I'm going down in price, 53, 52, I'd be losing money. So I'd first of all be going against the 21 cents. And then after I've gone past that 21 cents, I could lose, it could cost me more than 21 cents to close the trade down. I might have to spend 40 cents, 50 cents to close it down. Well, if I spent 40 cents to close this trade down, I would be losing, I would spend 40 cents. That would be offset by the initial credit I received, 21 cents. I would be losing the equivalent of 19 cents. So 19 times 100, that's $19, times 10, that would be $190. I would be, at that point, if I spent 41 cents to buy this trade to close it down, buy to cover it, I would lose $190 on the trade. Now, options are like every other trade. We go in with a plan. We understand what we're going to do. We understand what we expect to happen. We design a set of controls around the trade itself. In this case right here, I'm not going to let this trade go to zero. I'm not going to let it go so that I lose $1,700, $1,800. That would be absurd. I mean, just like you wouldn't let a stock trade go all the way to zero. You don't hold a long stock until it goes all the way to zero. You buy it back and you cover the trade. You close it out. Same thing here. So I would build into this a stop loss point, or I'd call it a risk exit. We don't actually use stop losses that much in the options market because the way that options execute, stop losses actually cause you more problems than they help. But we do very similar things. We have a plan. We have a point where we expect to exit the trade, all written down, clearly defined. When we hit that point, we basically close the trade out. We buy the trade, buy to cover the trade. We spend some money. That gets offset by the credit, and what's left over is what we've lost. But the point is that we can be making a full profit on the trade if the trade goes in the direction we wanted, stays right where it is, and even if the trade pulls back and does opposite of what we wanted. So we actually have over an 80% chance of being successful just because this symbol doesn't even need to do exactly what we want it to do or believe it's going to do. It doesn't have to go up. We're taking the trade because we believe there's a strong reason it will go up. That's one of the basis, of every trade that we're going to look at. We want to have a clear, unambiguous reason for taking the trade. But we also build the trade so that if they don't do exactly what we want, they can still be successful. And that's what this is all about. So I believe Nike is going up. But if it doesn't go up, I can still be perfectly successful all the way down to 51.50. And even then, I can still be successful down to another 21 cents below that before I even lose my money. Now, the last piece is this. Prices of options shift as time passes. The risk of an option, the stock price moving against the option seller, goes down when there's less time for the stock to move. So the value of the options go down. And this is where we get into time value. Now carefully watch this purple line, this P&L line. As time passes, 17th, 18th, notice how that line is slowly starting to shift. Now I haven't moved at all here, but my P&L is going up. So the price hasn't changed, but right now this purple line is moving to fit into the blue line, the final P&L. So here I am, and I'm on the fourth. I've almost got 80% of my max profit. It's actually sitting there. In a lot of cases, we'll consider that and make a plan to exit the trade early. walk away from the trade early, take less risk, make a little bit less profit, but turn around and use that money somewhere else. Or I can let it go for a couple more days. And once again, as long as I'm above 51.50, the options expire worthless, costs me nothing to close the trade down. I get all my margin back, plus I keep the profit. So does that make sense conceptually of how that all works? Now, each of these trades are going to be a little different, but do you get the general idea here? And let me be clear, I was not trying to teach you every little nuance of this trade tonight. We've got the tactics classes are going to go deep, deep, deep into that. The goal tonight for me was to teach the basic understanding of how the options work. What is an options market? Understand how the pricing works, how you can spot and understand at least the concept behind getting an edge in the trades. Take that on, move on a little further, and use the options in a practical way so you can start to see how they all work. See how the options market makers use the options and how they get their edge. And then finally, turn this into an actual real trade that is, honestly, this is not a bad trade. This is actually, I would consider this a decent little part of a portfolio. I'm not knocking it out of the park here. I'm not trying to go for a home run on this trade. There's other styles of trades where I can. This trade right here is a nice, basic, consistent money-making style trade. Not trying to be crazy, not trying to get rich tomorrow. What I'm trying to do is create a portfolio of multiple trades along these same concepts that generate good, consistent, repeatable profits. Avoiding, things that are going to cause my portfolio to be crazy risky, uncontrollable, unmanageable. Getting away from all of that stuff. So that is what the goal is. Now, I did want to show one other thing before we wrap it up, and I do need to wrap it up tonight. By the way, hit me with any questions you have. Any questions, any thoughts? And if we need to, we can take a little extra time tomorrow night. Who was it? I was talking to somebody about how instead of doing a long straddle or a strangle, how to do a different style of a trade over an earnings announcement. Who was that? I'm trying to remember. Oh, raise your hand or say something if that was you. Any play for Netflix earnings? I actually would be looking at that tomorrow, and yes, I probably would be doing a play for that. Lou, are you in my option strategist group also? Actually, you should be if you're here. I think you've got a month. All right. There's actually a whole list of earnings announcements coming up, and I will very likely be firing one off. I do need to get going tonight. If we need to, I have extra time I can spend tomorrow night to kind of answer the side questions and get into fun concepts and things. But I do need to get going. Tomorrow night we can dive into more stuff. I'm pretty sure that tomorrow you will be seeing a trade for either Netflix. There's actually a half a dozen different symbols coming up in the near future that are all looking good for earnings trades. I'll fire one of those off. Yeah, Rob, that's actually what you'll be looking at tomorrow. I'll tell you what, if I put that trade on, if I put one of those trades on tomorrow, what I will do, you'll just be getting an alert and the information, the basic information on the trade. But what I'll do is tomorrow evening at the end of our session, I'm going to have more time, and I will take some time, and anybody who wants to stick around a little longer, we'll dive into that and go deep into how and why that trade works. But I'll warn you, we're going from like the wading pool right now into open ocean swimming on that one. It's got a lot of moving parts. It's got a lot of pieces that you have to understand pretty clearly. I'm happy to talk it over with you, but be aware that it's going to be diving into the deep end of the pool. I have no doubt you guys will get there. I just wouldn't normally start with that trade as the beginning trade. Yes, well, Lou, what I'm going to be doing is I'm going to be putting the trade on as an alert tomorrow for the option strategist group. As long as it's a good trade, there's a chance that I may find it not be a good trade. I would put that on, and then we can actually analyze the trade itself after the market is closed tomorrow night, so you understand what's going on in the trade. And I'm going to flat out say this: please do not. I know that people take live trades based on the ideas and things that we throw around. We have to focus on education and paper trading. We cannot step outside those bounds. So please understand that what we're doing is not a financial advisor service. The SEC would kill us if we did that. But, I trust everybody to make their own judgment. One thing I'm just going to flat out say: never take trades that you see from any kind of service of any type that you don't understand how to manage on your own. Clearly, fundamentally, know how to make all the decisions. So what I'm going to do is tomorrow night, at the end of our session, I'll take some time and teach you all about the decisions that go into that trade. But please don't just throw money at a trade that you don't know how to manage. I don't want to be responsible for somebody losing money like that. I will do everything I can to teach you how to make the smart decisions, but take it step by step, have some patience, and do it when you clearly know how to deal with the trade. I just don't want to see anybody making a mistake that was avoidable and losing a bunch of money, and it is possible to do. Yeah, actually, Lou, I'll probably be sending it sometime mid-morning, and the stock announces tomorrow afternoon at 4:05. All right, I am going to wrap things up. I have to say goodbye, but tomorrow we're going to dive into the Greeks. We're also going to take a little time afterwards and take a look at the potential earnings trade that we might have put on during the day and get some questions together. I'd love to see some people interact a little bit more and have some more questions and thoughts and ideas. Makes it more fun for me, makes it more educational for you. And we will get there. So tomorrow the Greeks, Friday portfolios and engineering your trading system, and we will go from there. Lou, indicator link. Sure, I can do that. Give me 1 second. Okay. All right, Lou, go to this Google file. It may pop up on your screen as some kind of like code or something like that. There's a button on that page that says download. Download that to your local machine, and it should be let me see, I'll give you the name of the file. IVPER_HVRS_study.ts. You can then go in and load that as a study file into your Thinkorswim indicators, and you will have that available there. Now, if you have any troubles with that, the best thing to do is just reach out to Thinkorswim, and they can guide you on loading that file. I really can't give tech support on that, but that should allow you to download it. All good? And hopefully I'll have some more stuff for you guys too. I'm actually in the process of rebuilding some tools and some spreadsheets and things, and as we go, I'll share those with you, and you're welcome to get those tools for trading too. All right, got to get going. Thank you very much, everybody. I appreciate you being here. Looking forward to seeing you over the next couple of days. Especially looking forward to seeing the group that's going to stick around and do the tactics classes next week. That's going to be a good one. And I guess have a good night, and I will see you tomorrow. Thank you very much.